So today I'm here with Jeff, and we're actually going to talk about different types of insurance and what's a good fit for different people. Jeff, did you want to go in and kind of introduce yourself a little bit? Tell us about your past history.
Yeah, definitely. No, psyched to be here, Nav. And yeah, as far as experience and stuff like that, in the life insurance business, I've got about 25 years of experience, working with families, helping them find the right protection amount. And really, with today, what our objective is to pass on some info on a topic a lot of people aren't honestly, comfortable with talking about. So that's the big objective today.
Okay, thank you. So let's do this. Let's just start with the very, very basics. For someone hearing about insurance for the first time, what exactly is life insurance?
Yeah, with life insurance, I mean, people have a lot of thoughts about it, but truly in its simplest term, it's a contract between a person and an insurance company. And what that contract does is it guarantees that a lump sum of tax-free money is going to go to the loved ones of somebody who passes away unexpectedly or just passes away in general because they're old or whatever. But really what it does is, it allows families to carry on financially and provides the peace of mind that, if somebody does pass away, they're not going to have to worry about, how am I going to make the next mortgage payment? How are my kids going to still play in that, club soccer team? How am I going to pay for groceries, gas, whatever it is now that that income is gone? So in reality, life insurance, it's really for the living, the survivors and the people who are still around. And one of the easiest ways to look at it is essentially life insurance is essentially it's like funding a GoFundMe page in advance. So that's essentially, what it does.
So that's interesting because whenever I've thought about life insurance, in my mind, it's always around just death, right? But how you're
Exactly.
putting it, it sounds more of like it's more about protection and planning rather than just about somebody passing away.
Yeah, exactly. I mean, it's more so it's just like in the event somebody, who generates an income that their family needs and they depend on, if that person passes away, it puts the remaining people in a position where, yeah, they're not going to be screwed, that they're going to be able to continue on financially the way that they were able to, before that person passes away. Yeah, I mean, there's a bunch of different things with that, and we'll touch on some, but like one of the biggest things is like, the majority of people almost have like an immortality kind of like mindset where, if I were to ask you, Nav, like, hey, are you going to pass away by the age of 65 unexpectedly? I'll ask
I'm
you that
living
question.
forever.
Yeah, no, exactly. And if I were to ask like 100 people, if we had 100 people on this podcast, hey, somebody put in chat if you think you're going to pass away, unexpectedly by the age of 65, probably not going to get a lot of hands, going
Yeah.
up. So it's most, yeah, it's more so it's just like most people aren't thinking about that, hey, one day, this ride's going to come to an end. And the fact of the matter is, hey, we are all going to die. We just don't know when. So you've got that. Also, there's a misconception out there that, life insurance is too expensive. It's also, oh, getting a life insurance policy is complicated. It's going to take a ton of time. I don't have time to do that. I'm good. I have it through work. But really, what's funny about it, though, is if you look at those things, it's just kind of like excuses and procrastination. And the fact of the matter is, the longer you wait to get a life insurance policy, the more expensive it becomes. And, you know, honestly, the best time to get life insurance is way before you need it. Because just to give you an example, like the difference between getting a life insurance policy at 25 or procrastinating because you don't have the time or you think it's, too expensive and you wait until 45. Over the course of
Yeah.
time, I mean, that can cost you literally like thousands of dollars just by waiting. So those are really the main reasons that you run into.
I know personally of two types of it. You can kind of give us a better understanding of what that means.
Yeah, definitely. Yeah, first off, just to clarify, just with life insurance, like you get asked the question all the time, what's the best life insurance policy to have? And honestly, the answer to that is the one that's in place when you die. But as far as like giving a breakdown of things, if we look at term insurance is essentially what it's allowing you to do is it's allowing you to get a huge chunk of insurance inexpensively. So with it, what you're more or less doing is you're kind of like renting a death benefit. So you
Gotcha.
need $1 million in coverage, whatever it may be. An insurance company is going to charge you X number of dollars for it could be, 10 years, 15, 20, 30 years or whatever. And during that time, you're making your monthly payments. And if you were to pass away during that, 20, 30-year period, the insurance company is going to, give whoever the person you choose a check for whatever the benefit amount is. The downside to term insurance, though, is again, it totally serves a purpose. The fact that it allows you to get a ton of coverage very inexpensively. The downside, though, of it is once that term expires, just like, if you're renting an apartment or something like that, you're renting a house, when that lease expires, your 1 year lease, your 10-year lease or whatever on an apartment, landlord's going to be like, hey, cool, now I can charge more money for this. With a term insurance
Yeah.
policy, once that term expires, the insurance company is going to do the exact same thing that a landlord would do. They're going to be like, okay, this person's older now. Boom, we're going to charge them, a lot more money. So again, the huge upside it is you can get a ton of coverage cheap. And one thing I just want to point out, again, term totally serves a purpose, and we'll get into that later. But what most people don't know is just from a statistical standpoint, only 3% of term life insurance policies pay out. So if you're looking at a term life insurance policy, I mean, the odds are stacked in the favor, of the insurance company. And really that's why it's so inexpensive compared to a permanent life insurance policy. And if we look at it too,
So,
just as far as like, who's it best for?
yeah,
Because that's one of those things that comes up all the time. And it's like, it's really anyone who doesn't want to create, financial hardship for the people that depend on their income. And more often than not, it's a family starting out, with kids, they've got a house, they've got some cars. And really just for people who want to make sure, hey, look, if I leave this earth unexpectedly, that my family's going to be able to stay in the same house. They're going to be able to, make the same, payments on their cars. They're not going to have to worry about anything and not having to worry about paying bills. So that's kind of like who it's for. It's anybody who has kind of like a lot of obligation as far as things like mortgage, car payments, they're generating income. And if they were to like pass away, that if that income was gone, the family would be in a world of hurt. So that's kind of really who term insurance is for.
gotcha. So I'm gonna try to use myself as an example for a lot of these, just because you and me
Oh
are the
yeah,
ones that are
yeah,
having this conversation. So again, I'm in my early 30s. I think I'm fairly healthy. I have a mortgage. I have some cars. Would I be ideal for something like this, or would because I'm young enough and I feel that I'm healthy enough, I don't think that I'm gonna pass away in 20 years or 30 years. I'm hoping, to get to the 80s and 90s. Would this be ideal for somebody like me?
and it'd probably be a combination of the two things. Because like one of the things that I'll ask, because a lot of times, just like I'll be talking to people who are in their 20s or 30s, and I'll just be like, I'm single, I'm a renter, I don't need it. Where the question becomes like, hey, do you ever plan on getting married? Do you
Yeah.
plan on getting, having kids? In your situation, you already own a house. Do you plan on buying a house? Nav, in your situation, it comes back to, hey, look, I'll ask you. Do you plan at some point to get married and have have some kids?
At one point, let's see, hopefully.
Okay, so you've got that. When that happens, and as you build your agency, and you're making more money over the course of time, do you think you'd probably
Yeah.
upgrade to a new house and stuff like that?
Yeah. Upgrade to a new
Yeah.
house, probably upgrade my cars.
Yep, exactly. So it's one of those things where with it too, even being in your 30s or whatever, if you know that those things are probably going to be happen, and those are goals of yours. Hey, look, I want to make more money. I want to get married, I want to have a kid, 3 kids, 10 kids, whatever it may be. And eventually I'm going to need a bigger house and stuff like that. Getting the term piece of it now, at least for the next like 30 years, brings you into like your mid 60s or whatever.
Yeah.
And with that, if you do it now as opposed to, okay, you don't get married till you're 40 or whatever, and stuff like that, doing it now makes it so much less expensive. And I know we're also going to talk about it too, but how I was saying, like a combination, depending on what somebody is looking to do with life insurance, there are also like permanent life insurance options. And I know we're going to get into that, but essentially a permanent life insurance option is one that, goes on forever.
Yeah. And that's actually a great way to kind of walk into that next, chapter of that. Let's talk about whole life. We kind of touched a little bit on term. We got a slight understanding of who would be a good qualifying person for this. Somebody that's, early on in their career, starting to build a family, doesn't want to take on a huge expense, but still wants some kind of security for their family if anything happens to them. What is the difference between that and whole life? And who would be an ideal candidate for that?
There's like a misconception, just people, the street term of a life insurance policy, whole life, is one that lasts forever. It's actually one of three permanent life insurance policies. And what a permanent
Okay.
life insurance policy is, when I was talking about like, term insurance, it's like, hey, look, you're running a death benefit for a certain number of years. When you get into a permanent life insurance policy, and I know we'll touch on, the major three that are out there, it's the difference between buying and renting. Because how it works with a permanent life insurance policy is part of the premium that you pay goes to cover the actual death benefit.
Yep.
And the premium for that death benefit is almost identical to what it would be for a term life insurance policy. However, with a permanent life insurance policy, you're required to, depending on the type, pay an additional amount of premium. And what that premium does is it essentially goes into a cash bucket. And the money that goes into that cash bucket, depending on what time permanent product it is going to continue to compound and grow over the course of time. So really with it, the money in that cash bucket, so part of the premium is going to the death benefit, part of the premium is going to this cash bucket. What's happening over the course of time is, as that money compounds and grows, which can be anywhere from like 3 to 10%, depending on the type of policy, it's like buying a house. As you keep making your mortgage payments, you're building equity in your house. The same thing happens with the life insurance policy. And typically speaking, about 15 years into making those premium payments, if you look at what you've paid in premium versus what's in that cash bucket, it's almost like a break even point, where if you look at it, what you have in that cash bucket versus what you've paid, it's almost identical. And once you hit that point, the money continues to grow. And a big part about money in the cash bucket that you have, is it grows tax free. So when you need
Mm.
access to that money, and once you have money in that cash bucket, you essentially can borrow against yourself. You can take money out and it's tax free. Uncle Sam doesn't touch it, doesn't get his cut, and you have access to it really at any time you know, without any penalties as long as you pay the premium.
See, as soon as you said tax free, I'm sure a lot of viewers are like, now you have their attention. And you mentioned there's different types and different percentages that you can earn on some of these cash buckets. And I'm guessing that varies off of the different kind of whole life policy.
Yeah, and again, permanent life insurance policies. So I'll go through like a whole life policy. What a traditional whole life policy does is it's going to give you a guaranteed premium, a guaranteed growth amount for the money in that cash bucket, and a guaranteed death benefit. And
Okay.
typically with a whole life policy, it's more kind of like on the conservative side. And generally speaking, if you have options, and I'll talk about other options, if somebody who's say like in their 40s plus, whole life is probably the better option because the money that's going into that cash bucket is typically going to grow anywhere from 4 to 5.5% per year. You don't have to worry about like if you have money in the stock market or something like that, losing money. It's just like compounding interest. You have money in a CD or something like that. With a whole life policy, it's
Yeah.
giving you the death benefit and the money's going to grow, up to whatever, 5.5% per year. So it's more so it's
Right.
as far as the permanent life insurance options, it's the most conservative, but it's filled with guarantees. The next
Okay.
option that falls into this, permanent life insurance, portfolio, so to speak, is something called a fixed index universal life policy. And with that, it works the same way as the whole life, any permanent product that part of the premium that you pay is going to go into a cash bucket. And when you get into a fixed index universal life policy, instead of giving kind of like a guaranteed rate of return, what it's going to give you is a rate of return that's based on how one of the major stock indices performs. Most typically, it's the S&P 500. But the way these are
Gotcha.
structured is it'll allow you to take care of or take advantage of modest gains of, say, the S&P 500 up to about like 10%, somewhere between 9 to 10%. It also has downside protection and with something called a floor of zero, which means if the S&P 500 tanks, you're not going to lose all your cash value. So if we're looking at an index universal life policy, if the S&P 500 goes up 20% in the course of a year, your cash value
Yeah.
is going to grow 9 or 10%. If the S&P 500
Okay.
goes up 7%, your cash value is going to grow 7%. If the S&P 500 loses and goes down whatever, 1%, 20%, 50%, you've got that floor, in which case it's not going to impact the cash value. So that's the index universal life policy. And that's more so, just in my opinion, like people who are like, your age, 20s or whatever, that's more of a suitable option simply from the standpoint of you have a longer time horizon. You can actually
Gotcha.
like take the gains, and the losses, over the market for an extended period of time. And like with the S&P 500 for like the last 30 years, it's given an average rate of return of like 8%. So it's kind of like if you have that
Okay.
longer time horizon, it's not going to like, crush you if, for 3 consecutive years, the cash value doesn't grow. It's a great product. And the third one is a variable universal life policy. And with this, same concept of everything that I was talking about, but the money that goes into the cash bucket is actually being invested into mutual funds. And depending on what mutual funds you're in, you can see like wild swings, of your cash value, like growth and losses. There's no cap as far as what the cash value can grow by. And there's also no cap downside protection if those mutual funds tank. So those are really the three options. And it's kind of like I look at it for somebody who's more conservative. Hey, look, I'm just looking for a guaranteed rate of return, say 5.5% whole life. Hey, look, I don't want to deal with these like large swings and the money in the cash bucket. I want something that's going to give me more than 5% consistently over the course of time, a universal life policy. Or somebody who's just like, hey, look, I'm willing to, depending on what funds that, are recommended and I decide to go with, that I'll deal with the swings in the market. That's also a viable option for, again, anybody really, in my opinion, under the age of 40. It's anybody who's in a position to buy versus rent. So anybody who's in a position, like, hey, look, I've been renting, this house for, 10 years. I'm just like paying somebody, I'm building no equity or anything like that. I should probably buy
Yeah.
a house. It's the same thing with permanent life insurance. If you're in a position to buy versus rent, and again, the renting piece of it definitely serves a purpose, especially, with people who have a lot of like financial obligations and you want to create financial hardship, in the event that somebody passes away, you know, unexpectedly or whatever. But it's really if you're in a position to buy something, because again, as we talked before, and I'll just kind of like recap on this, with a permanent life insurance policy, just like buying a house, each time you make a premium payment, you're building equity in that policy. And really what it is typically, again, like 15 years in or so, you've paid enough in premium and it's built enough cash value that the policy almost actually kind of becomes free. Because if you look at what the cash value is growing by on an annual basis, it's outweighing the
Yeah.
premium. And again, what's awesome
Okay.
about like a permanent life insurance policy is once you have cash value in there, you can actually take money out of it, again, tax free. You can use it for
Okay.
whatever you want. It could be like, hey, look, I want to put in a new kitchen in my house, or I've got enough cash value. I've got a kid that's in college. I need some money to pay for a semester in college. You have access to that tax free. And, you know, and it just continues to grow over time. Even if you're accessing money, you still have that death benefit. You can take a loan against the policy. You don't even have to pay it back. What it'll be is just kind of like the initial death benefit will shrink by a little bit. But again, the death benefit becomes a combination of what you have in cash value and what the initial like protection amount that you got was. So it's one of those things where if you're and as long as you make the premium payments or you get to a point where you have enough equity in the policy as far as cash
Yeah.
value, you can just be like, I'm done making premium payments. I just want
Yeah.
this policy for the rest of my life. So those are really kind of like, the huge advantages of it. And it's just kind of like I say, like it does cost more because it does have that cash value like component to it. But at the end of the day, it's gonna generate more than you put in premiums. Where if you have a 20-year term policy, whatever, $1,000 a year, you paid 20 grand. Hey,
Yeah.
20 years from now, that's awesome. You're still alive, but you're not going to get that 20 grand back. Where if it's in a permanent life insurance policy, 20 years you paid that, whatever it might be, instead of $20,000 in premium, like 25, $30,000 in premium. 20 years later, you're still alive. Hey, cool. I've got sitting here in cash value more than I actually paid into the policy. And I still have life insurance. I don't have to reapply now that I'm 20 years older, where the rate's going to be like astronomical compared to what it was
Yeah.
when I got 20 years ago.
So it looks like it might take a little bit bigger investment per month, but in the long run, there are more benefits that come with it. And again, for the audience, this does not mean one is right for you or the other one is not. It's all about what your needs are and what you're comfortable with. This is just us discussing some of the different benefits that come from each one. But yeah, so term will expire. If you don't die, nobody gets anything. With permanent whole life, there's a cash benefit that you can get even before you pass. And then there's obviously the death benefit that happens no matter what, as long as those premiums are made. Correct?
Yep, exactly. And again, like we were talking about before, I mean, there's no right or wrong life insurance policy to have. And again, the best life insurance policy to have is when you pass away, the
The
one
call
that's actually
when you
enforced,
pass.
not the one that
Yep.
expired 10 years ago or the one that you procrastinated on and never got. The best life insurance policy to have is the one that's in place on the day that, you pass away.
Gotcha. Interesting. Okay, so let's talk about index now. I know you said there's two types of index funds as well. I'm learning about index funds right now as well. So I don't even think I've scratched the surface on it. So give me like the basic understanding of what the index fund is and how it can help somebody like me.
Yeah, with the fixed index universal life policy, again, what's happening is you're paying a premium. Part of the premium goes to cover the death benefit. The
Yep.
other part of the premium, again, is going to go in a cash bucket. And that money in the cash bucket is instead of giving a guaranteed, rate of return like a whole life policy does, it's going
Yep.
to follow a stock index like the S&P 500, the Nasdaq, the Russell 1000 or whatever. It'll follow that and it'll give a rate of return based on how those perform. And with it though, the way those policies are structured is they allow you to take advantage of, modest gains in the market, typically up to, 9 or 10%. But they
Okay.
also have downside protection, which is known in, you'll hear it as a floor of zero. And essentially what that means is depending on how that stock index does, be it the S&P 500, which is the most common, versus NASDAQ, the money that you have in that cash bucket is going to grow somewhere between, 0 to 9 or 10% per year. And how it works is S&P 500, NASDAQ goes up 20%. You get to take advantage of, say, 9 or 10% of those gains. If it goes up
Okay.
by 5%, you get to take advantage of 5% of those gains. The downside protection piece, the floor that I mentioned, is if it tanks, the NASDAQ, S&P 500, they drop 30%. You're not going to lose 30% of your cash value because you've got that floor.
Gotcha. Okay. And then who's that for? We talked about who permanent whole life could be for. Who could index life be for?
Yeah, it's really, I mean, just I look at it like we were talking before, just really kind of somebody who's got a longer time horizon. When I was talking about like whole life, generally that's more of a product that I'm talking about with people who are, over the age of 45, more so kind of like getting into their 50s, where they're looking to grow something that's kind of like guaranteed. They know it's going to guarantee, they put their head on the pillow and they know that it's going to grow and, grow by like, 5% a year or whatever. Where if you're under 45, 20s, 30s, kids, whatever, where they've got that long time horizon where they can, deal with the swings of the market. Like the S&P 500, for instance, has been on like a crazy roll. But if you look at 2008, it lost like a ridiculous amount. It's way rebounded since. So if you're in a position where you can deal with a few years over the course of time, say like a 30-year time, time period or 20-year time period where that cash value is not going to grow, you know, even 5 of those 20 or 30 years, but you're going to be able to pick up like 8, 9, 10% the other 20 or 25 years, then it's like a product that probably makes a lot of sense.
So I'm going to use again myself as an example. When I invest money or I put money into anything, I kind of do it in a way where I put something in and then I forget about it. Because for me, it's like when I take that money out of my account, I pretend that it's gone. I never had it. I'm never going to see it
Yep,
again.
which
So
is
would
good.
that
That's a
be
good
for
way of
me?
thinking.
Yeah, because look, for me, as soon as that money comes out of my account, it's gone. It's never,
Yep.
I don't expect to ever see it again. So would that be an ideal candidate for somebody that's looking to open up a life insurance policy? Index policy would be good for me.
Yeah, 100%. Yeah, where it's just kind of like with anything else, just you look at it, people are like, again, life insurance is too expensive, or I can only afford term insurance. If you look at, if you really sit down and do an analysis of kind of like what you spend money on, be it whatever, Starbucks, drinking beer, just whatever it may be, playing DraftKings and stuff like that. If you're like, hey, look, if I were able to take out, cut that down by, drink 5 less Starbucks coffees a month.
Yeah,
There's another $40 or whatever. To your point, it's just all of a sudden now like I put that into a permanent life insurance policy, and yeah, it's like set and forget. You just adapt to the new budget. It's just more so you have
yeah,
to be willing to, hey, look, I understand, how this is going to benefit me over the course of time. But hey, I have to not give up, but kind of like cut down on, one of the luxuries that I give myself right now. And if you do that, if you look at whatever, you cut out $50 a month at Starbucks, and that's actually going into like, a permanent life insurance policy over like an index universal life policy over the course of time, that $50 that you're cutting out of an indulgence is going to be mean like thousands and thousands of dollars to you over the course of time as far as cash value growth, to make your retirement a little more fun and stuff like that.
interesting. Okay, we'll definitely dig a little deeper on that soon. I think this all was good, and this gave me a basic understanding of everything again. And I'm hoping that some of the viewers that did not have a understanding of life insurance at all or had a stigma around it, this is going to help them kind of start to get a understanding and kind of open up a little bit more about even discussing this. And again, this isn't something that you just go to any Joe Schmo and you just like, hey, I want life insurance. I think this is something that you should find somebody that you're comfortable with, somebody that you can discuss stuff with, because again, life happens, things continue to change, and things in the policy might change, things in how you want things set up might change, and it has to be with somebody that you're willing to sit down and have these discussions all over again with.
It's really, if you were to pass away today, would your family be able to be in a position to focus on grieving that you passed away and remembering you? Or, holy crap, he's gone or she's gone. How am I going to make the mortgage payment? How am I going to do this? How am I going to do that? So,
Yeah.
really, the question is, just what people need to like think about and self-discover is if you were to pass away, what would it mean to your family? And with what in your current state today, what would the situation be like for your family with not having life insurance in place versus having life insurance place?
No, no, honestly, I had this discussion with a friend of mine. He was recently telling me about his dad and how he didn't even tell anybody, but he had pre-planned a lot of stuff. He had picked out a coffin, a cemetery site, like everything was already picked out for him and his wife, and none of the kids knew about it. None of that was discussed with them, and all of a sudden now, when one of them passed, all of that fell into place, and the kids were actually able to take the time to grieve rather than be worried about everything else.
Exactly. Because I mean,
Now, I
you
think,
look at it, I can't even imagine like the stress like you see on social, like, whatever, Facebook, Instagram, or whatever. People are posting like somebody passes away unexpectedly, having to deal with like setting up a GoFundMe page and
Yeah.
having to rely kind of on the generosity of others as opposed to being able to like truly be like, oh, this person passed away. Let me focus all my attention on, the grieving aspect of it and getting past this and remembering this person as opposed to, yeah, how am I going to pay for a coffin?
Yeah. See, I think this was a great starting point, and I think for the first episode, we touched on a lot of good things. We touched on a lot of things. There's always some kind of takeaway that, you know, we want the listeners to hold on to before the next episode comes out. And is there anything in particular that you would, even for people to kind of not just think about, but maybe do some research on their own about before we do come out with another episode?
It's just like taking a moment and really thinking about, hey, if I were gone tomorrow, what would it mean to my family financially? Would they be in good shape or would they be screwed? And if the answer is they'd be screwed, then it's probably worth having a conversation.
Yeah, makes sense. Thank you, Geoff, for coming on. And again, hopefully we keep these episodes going and we continue to inform everybody that we can and, spread as much knowledge as we can. I think this is more than just about insurance. It's about protecting your future, your family, and the life you're trying to build. So because of that, I think the more we educate and tell people some of the benefits that they have available to them, I think it'll help them build a better future.
Now let's continue these because we haven't even like scratched the surface of stuff. Just as far as like, hey, I'm set, I have it through work, or what it can do
Yeah.
as far as like, you know, being a tax-free source for retirement and all sorts of stuff. So yeah, we're just scratching the surface on this topic.
I think the next episode, I think we'll talk a little bit about getting insurance through work. And one thing that I've been hearing a lot about, I have a lot of new parents that are asking about insurance for their kids. And I think that's going to be a very interesting topic. And I think we should definitely do an episode on that.
Yeah, totally agree on that one because yeah, you can essentially set your kids up if it's structured properly, and we'll get into this for financial freedom for the rest of their life with a properly structured policy, which gets into like the permanent stuff that we were talking about before. Don't get me started on that. Let's wrap this up and let's do that another time because it's a great option.
So
Oh yeah,
again,
nope, we
this
totally would because I mean, it's a great concept. It makes all the sense in the world for a multitude of reasons. But again, you brought it up again, and now I'm going to start talking about it. So I'm just going to be quiet here, man, and let's wrap this thing up. All right, man. Always cool to see you. Enjoy.